click on the record button, okay? So welcome everyone. Welcome to this new questions and answers webinar for the 1st February 2020. You know how this works. Well, Peter, everyone is saying that they are hearing me perfect, loud and clear. So anyone having problems with the audio? Anyone? Nope. Everyone's saying loud and clear, so it should be on your side, Peter. Yeah.
Yeah.
Oh, okay, good. I don't know why. One sec. So, mute. I don't know why this happens. Okay, good. So let's get started. Okay. So today I'm gonna cover some of these scenarios you can see here on the right side, and as you already know, you are welcome to propose or ask me to go over any asset, forex, stock, or anything. Okay, so if you are interested in going over any asset, just type it in the chat box and I will put it down on my list and we'll try to go over it once I go over these ones over here. Okay, so just let me know. So we're gonna try to cover today the arrival into a level, and obviously the consolidation way will be present on every analysis because that's, together with the strength of the impulse, the most important features of an imbalance. We want the consolidation away, the strength of the impulse, and we're going to be talking about the arrival at the level because it happens many times that the imbalance is great, but the time value, and with the time value I'm saying the time that price takes to arrive to the level, how fast it does, compare it to the previous candlestick or movement. Okay, so let's start with the pound dollar because this week we were discussing this quite a lot. Okay, so as you can see here, the monthly is, I'm gonna draw this. I've got clean charts, so we can do this from start. So we've got a monthly area of demand down there. So the monthly is consolidating. We are having new areas of demand being created, bullish impulse as confluence. We've got this weekly area of demand in control, okay? And we were discussing about this particular scenario here because we've got an area of demand down there, okay? And we also had another one at the bottom because we had the trend line break and all that. Demand, there was demand over there. Why demand there? Because we had a trend line like this. Then this was supply. Then this is demand. Okay? And the same thing happens with the daily. There was lower low here. Tested area of demand has been eliminated and all that. So what we are going to discuss is about this area here. That one over there. Okay? So I want to ask you, is that a valid area of demand on the 4-hour? Yes, it is, because we said that it removed that area of demand, supply, sorry. But was it a valid area of demand to go long, anyone? And why was it valid or invalid? We already covered this in the community, but maybe you didn't read the posts and the comments. We were discussing about this. So let me go over this. We've got here, you're gonna see the crosshair. Okay, one sec. You see there, we've got this daily bullish candle, and we have the interchange zone there. Within that interchange zone, we have that very strong area of demand on the 4-hour, super strong, and remove that area of demand over there. So the thing is that if you take a look at the daily, right there, okay, by the time price reached that 4-hour area of demand at the interchange zone, the daily, I was online at the moment and I posted in the community, the daily was like there at the 4-hour area of demand, and it was only probably 9, 10, 10:30 a.m. in the morning. So that means that the market has been open not even half a day, okay? Not even half a day. Okay, so if you compare this bullish candle there and the bearish candle, by the time price reached that there, this candle on the left took 24 hours to be created, whereas this red candle, while it was opened and being formed, it had taken about 11 hours or less to be formed, if we take into account 00 hours, okay, midnight. So if you compare this candle, the one on the left and the one on the right, this is telling us that the bearish strength of that candle is stronger than this one. So we should not be thinking of going long down there at the 4 hour, no matter how strong it was. Just because of the arrival into the level, it took, yes, 12 hours to form that level, and it took less than 12 hours to form that level. So, and this was just half of the day, the other half of the day was here, and then in half of the day, this bearish impulse on the 4 hour was stronger than the bullish impulse on the left. You can see that on the daily. Does it make sense what I'm trying to say here? It's not easy to explain, okay? So I'm just trying to use the pen and all that to cover the areas I am pointing out, okay? So monthly too high as well too high, John F. The thing is that the monthly area supplies up there. So, well, price is here. It's not high, it's right in the middle. So if all this was happening right there, then it would be high. But right now, it wasn't high because price was right there. It was like probably at 60% in the range if we measure from the proximal line of that area of demand and the distal line of that area of supply. So it wasn't high. Okay, we had a confluence in the monthly, bullishing of the pattern. We have weekly area of demand in control, but we can also add another bearish confluence for that would prevent us from going long. What can we see here? We already covered this scenario here on the bearish impulse on the daily, but what about this one? What can you tell me about this one? These two candles. Anyone? Or three candles? It's related to what we just said. So let me read you. So I'm gonna read you once I explain, okay? So bearish engulfing pattern, but yes, Jaimus. But the thing is, how long did that candle take to be formed? That one, the white one. This is a weekly chart. So that's 5 days. 5 days to be formed, okay? Also no consolidation away, France, yes. So what about this one on the right side? This is a new weekly candlestick. So this, if the candle was closed right now, if it was Friday at 10 p.m. Central European time, this candle will be closed. Okay, so we had now no consolidation away. The bearish engulfing pattern is fully confirmed. But this morning, okay, price was there, and today is Tuesday, so it's 1 day and a half only, and still 3 days and a half for the bearish candle in the weekly to be formed and complete as and consolidate as a bearish engulfing pattern. But if you can see here, this candle took 5 days to be formed, and by the time price was there, okay, it was only 1 day, 1 day and a half. So what do you think is stronger? 5 days price rallying or 1 day, okay, 1 day and a half dropping? Does it make sense? Does it make sense? Yes, John F. It looks like it makes sense to you. So that's the thing I am talking about. So if this candle takes 5 days to be formed, and the next candle in the making today was Tuesday morning, it took just 1.5 days for this weekly candle to be stronger than the bullish candle. That means that we've got a problem. Okay, so anything there, we should pay close attention to that and that should prevent you from taking the longs. So what you should be doing here, setting alerts and all that, and then once you set the alert, then you look at the chart when you are in front of the computer, and then you decide if the arrival to the level is correct, if everything is looking good, consolidation away, and all that. So that should prevent you from taking many losses, but also that will prevent you from also having lots of winners. So the ideal thing is that when any area of demand is being formed, the basic structure, then price rallies, consolidates away after a very strong impulse, and we don't have the next candle returning to the origin of the move sooner than or faster than the time that it took for price to rally from the original base on the impulse to the highest high that was printed, if we are talking about demand. Okay? The tendency to drop is stronger, as Anwar just mentioned in the chat box. Okay? So that's what we were, or I was trying to explain this morning in the community, and sometimes it's hard to explain all that. So let's take a look at another example on pound Aussie. Okay? Right there. So we've got pound Aussie. We've got the month is in an uptrend, the weekly is in an uptrend, an area of demand has been created here, price rallying, and as you can see here, price is dropping, and it took 5 days for this candle to be printed, and only 1 day and almost 2 days for this bearish candle to be printed. Okay, we've got a very strong area of demand here on the daily, which is now in control. But as mentioned in my explanation in the pound dollar, even though this one is trying to play out, okay, it's trying to play out, it could happen that price tries to rally and reaches that 4-hour area of supply, okay? But what happens here? We've got these two candles on the weekly. This one on the left, okay, took 5 days to be formed. This one on the right took 1 day and probably like about 22 hours, more or less, okay? So this one here wins over the one on the left side, okay? What we want to see here instead is this: price rallies on the daily, then it stays here for 1, 2, 3 days. That would change a lot here. Let me show you what it would look like. So imagine them, I'm gonna use the replay functionality here. Okay, if it wants to work. Okay, like that, okay? So the thing is this: if we get these 5 days and then the next week, this week, current week, okay? Forget about these two candles, they didn't happen, okay? So we get another candle like this on the weekly, basic candle probably. Then do you think that scenario would give more odds to the interchange zone and the daily area of demand? Anyone? Anyone can answer? Yeah, Frederick saying yes, and everyone saying yes. So does it make sense what I'm trying to say? Okay, it should be logical to you. If it is not logical to you, then you will find it hard to do the same exact analysis on other assets when you are on your own. Okay, so the thing is that if we get these impulse here, these 5 days, that weekly candle there, that would mean that we would have probably here 3, 4 basic candles on the daily. Okay, right there. We would have instead here, this wouldn't exist. So I'm gonna make it clear here. I'm gonna stop the replay. I wish that TradingView allowed to use the replay functionality on all time frames at the same time, but it just works on one single time frame. So I have to reset the replay functionality here and then choose the daily time frame and the toggle on the replay functionality on its own here. Okay, so if we had these weekly impulse, okay, staying there, consolidating away a little bit higher, then we would have had something like one candlestick there, two, probably another basing candles, or probably a bearish engulfing pattern, four, and then another candle like that, five. So that, okay, would make like a candlestick like this on the weekly, probably a basing candle. Okay, forget about this one, it doesn't exist. I just cannot delete it. Okay, the replay functionality that I'm using on TradingView doesn't work on all 4 time frames at the same time. Okay, so imagine if that was the scenario, then having a basing candle there would mean that this daily area of demand right there would have much higher probability, because we had the current weekly candlestick being weaker than the previous bullish impulse. So that would have been great for a significant long. Make sense? Anwar is asking, does this indicate a kind of balance in the market? Yes. Something like the one candlestick that we can see here on the weekly time frame. This is telling us that the weekly is more or less at balance. Well, not really. It will depend how this weekly candlestick ends up, but right now only 2 days and price almost cover 80% of the previous candlestick. So that is a little bit aggressive. Make sense? You're going to see that some levels like that is going to work even with this kind of arrival. I'm just telling you, if you want to go conservative, then this is the way to go. You will avoid very many losses. Okay? So if this is happening at the beginning of the move, it's not a problem. But if it's happening after a very strong rally, then we've got a problem. Okay? Make sense? Brian, yes, he's saying, so we should always look at one time frame higher than the entry time frame. Yes, that's always like that. That's why we have the realignment rules, where we have 3 time frames: the monthly, the weekly, and the daily, just for the sake of simplicity. So if we are looking to trade at the weekly, at the daily, we look at the weekly and see what's going on. Okay. So after a very strong rally, usually price retraces to the origin of the move. Okay, the interchange zone is great, but the arrival into the level, the time value of the candlestick, it counts a lot, as you can see. And if you analyze the charts with this in mind, with this kind of arrival, then you are going to find that it would prevent you from having many losses if you follow that rule. That's going to filter out many great trades as well. So it's something that you need to test and you need to see with your own eyes and brain to assimilate this kind of arrival. Okay, there was a lesson talking about all this in the past, but I had to eliminate it because it was a little bit complex to explain all these kind of scenarios, and people were just understanding the arrival in a different way. So by having the time value incorporated in the arrival, it's going to make much more sense. Okay. Okay, good. Any more questions about this one? About pound Aussie, pound dollar scenarios before I carry on with other scenarios? Okay, TB, clear, Frederick, Brian, everything clear? Okay, perfect. So let's continue. I'm going to jump to the dollar index versus the Chinese yuan. Okay, so we've been talking about this for quite a long time. We've got a monthly time frame. Month is in an uptrend, and when price was right there at the top, we were saying, well, this is not good to go long in these areas here. If there is any, I'm going to look at that now with you. Okay, so we are waiting for price to retrace all the way down, and this is happening after breaking all-time highs. Okay, all-time highs broken, very strong impulse. one single ERC candle, but this ERC candle is much stronger than the average. So it is good to do one imbalance, one over there, 2, 3 point something to 1. So it's the level scores great. Okay. So I'm going to read you now, John. Okay. You send me a private message over the chat. So here we are. So month is in an uptrend, long bias. 3 months in an uptrend as well. Okay. So what do we have on the weekly? We've got this area of demand on the weekly down there. 1 sec. Down there. Come on. What's going on here? Right there. That weekly area of demand over there. That weekly area of demand is, as you can see with crosshair, it is nested at that monthly area of demand. You were allowed to go long there. I know that some of you went long over there. The strength of the impulse is really, really nice. We had 2 ERC candles. As you can see here, once price rallies over there, we start seeing that the weekly is losing steam. We get a bearish engulfing pattern. Then, following that, we've got a weekly area of demand over there. Okay, all-time highs broken, consolidation away happened, but it doesn't score not even a 1-to-1 because this is 1 R, then it should be around there. If you multiply, okay, from the proximal line to the distal line, right there at the top would be 1-to-1, and we want 2-to-1. So that is not even 1-to-1. So we just can't go along there. It played out okay, a little bit, but then price dropped again. Then a weekly area supply was formed. We were talking about this in the community and the weekly video analysis, and then price was dropping. Tried to reach that weekly area demand. It couldn't. Rallied and then dropped again, and it was there that the weekly area demand was hit as expected. All this was called in the video analysis and in the community. We were saying, okay, if you are a trader using the monthly sequence, then longs are allowed over there. So where can you go long on there? You can use half of the level to trigger the trade if you are not don't have enough capital to trade the weekly average demand. So what do? So half of the level will be like around there. Okay. So always the stop loss should have a padding of 25%, okay, underneath, and then probably 3-to-1 already. Okay, so that's the kind of set and forget trading that we want to look at. Okay, on Forex is much more difficult to see these kind of clear scenarios. This one is one of those. Why? Because unfortunately, if the euro is consolidating, then most of the euro cross pairs are going to be consolidating, and then in consolidation, set and forget is not a good idea. It's not allowed. We need to wait for new levels in order to trade. We need to wait for confirmation, okay, as per the rules. Okay, all clear in this one. So this is the kind of setup that we are looking to go long at. So right now here on the daily, we have an area of demand created down there, as explained to the community. Since it is one single candlestick, then we can use the whole, the upper, the highs here, the upper wick and the lower wick, or we can use that one. Okay, so that would have been great to go long if price would have retraced, but it just didn't. Continue to rally, and now we have price has been rallying quite a long time. Okay, so we are expecting price to drop farther down to the origin of the move, and as you can see here, we also have today a bearish engulfing pattern. The bearish engulfing light lesson, the engulfing lights, is telling us that after strong rally, a bearish engulfing pattern happens, and then we are expecting price to go to the origin of the move. That doesn't mean that we can go short, okay? Only if you are using another sequence, not the monthly. In the monthly sequence, shorts are not possible. In order to go short on the monthly sequence, what do you need? If you are using the monthly sequence, anyone? Come on. The monthly sequence is made of the monthly, the weekly, and the daily. What do you need in order to go short in the monthly sequence? 3 time frames, counter trend. What does it require? The month is up, Exactly, Jay Mursi said that. Weekly out of alignment, the middle time frame out of alignment. So is the weekly out of alignment for aligned for shorts? I mean, again for shorts? It is not. So let me do something here. Let me show you what the weekly looks like with the trend line and all that. So here, this is one of the trickiest scenarios. I'm going to draw it to you. I explained it, I think, this morning in the community. So is this price action over here? You could say this is a pause, CP, and all that, but let me explain to you what it is. So if we read price action over there, there is a clear drop, rally, and this is dropping, okay? It drops. And this is not a pause. A pause doesn't happen like that, okay? A pause, like, I mean, this is quite big, as wide as probably this bullish ERC candle. So this one is a drop, then it rallies again, and then it drops again. You have to be very careful reading this kind of price action, okay? You can possibly miss it. I'm just pointing it out, okay? This is a rally, drop, rally, drop, like this. So if that is so, then we are allowed to draw a bearish trend line. So that trend line is broken and a brand new area of demand has been created. Make sense? So that's an area of demand on the weekly that is the confirmation of what? Of a monthly area of demand in control with a monthly in an uptrend and a very strong area of demand on the weekly. It is also made of a quite solid and tight weekly bullish engulfing pattern, which is also a confluence. So we are having lots of confluences for long. Monthly uptrend, demand in control, nested weekly area of demand in control, brand new area of demand on the weekly. So after a very strong rally on the weekly, we are expecting a bigger retracement. We've got all this price action here on the left going long right now on the 4 hour, on the 1 hour, and all that. Even though price will continue to rally, it is not a good idea. In hindsight, if we look at this and then price is running from there even higher and to up there in 2 days time, then it's great. I should have taken this long over there, I should have taken this, blah, 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 and all that. But in hindsight, everyone can trade. We're not talking about hindsight. We are dealing here with scenarios where we are explaining what is the higher probability scenario happening here. After a strong rally and all that, with this price here on the left side, this is an obstacle, and that will probably allow price to retrace to that area. That doesn't mean that we should be thinking of going short. We need those obstacles in order to have price retracing to the origin of the move. Longs will be possible down there again, John. Okay? So let me read you, as per the rules, where we allowed to go along on the last 4 hour every month. But you are talking about which one at the top? John, you were talking about pound Aussie? Probably. So on the pound Aussie, on the 4 hour, say, there, you mean 4 hour here or here? I read your message, your comment late, so sorry for that. Okay, so after, let me clarify this. I don't need your answer really. After a strong rally, okay, forget about 4 hour over there. Weekly, so we're waiting for a bigger retracement. 4 hour not allowed. Okay, minimum the interchange zone. The rules are this as being the this one over here, over there. I need to do the chain analysis, John, in order to know if this is demand or not. But the thing, let me tell you, when you have, let me use whiteboard, will be clear. This should be the whiteboard functionality. Okay, so this is the whiteboard. So this is what you need to pay attention to. Okay, the imbalance is right down there, basing structure. Okay, then price rallies. If we get 2 ERC candles, 2 ERCs, let's say 2E, okay, then we are allowed to go long at the interchange zone. So if this is the weekly time frame, then we can go long at a daily interchange zone. Make sense? Everyone following me? Is this clear? That's one scenario. Okay, that's why I always say, and the rules are very specific and clear about it. We need 2 ERCs, 2 to 1 and all that. Closing at about 80% of the candle range. That means from the high to the low. Okay, so now imagine this scenario. We've got 1 candle there, 2 ERCs, and 3 ERCs. So we've got 3 E's. Okay, and this is the demand area on the weekly basic structure. Okay, so here we would have 1 interchange zone. Here we would have another interchange zone. Make sense? Would we be allowed to go long here? Interchange zone number 1? Anyone? If no and yes, why not and why yes? Brian is saying overextension. Some people are saying no, yes, no, yes. So the idea is this: after we have 3 ERC candles, what happens here? So if we have 3 candlesticks, okay, 3 ERCs. If this is the weekly time frame, then we have 5 daily candles, haven't we? On every single ERC. Make sense? 5 daily candles. So that means that in total we have 15 days or candlesticks. You follow me? 15 days. So how many pauses, CPs, on the daily time frame can be created in 15 days? Only 2. Syed, I don't think so. 15 days, quite more than 2. Okay, so in order to have a CP, we need, okay, I'm going to go here on the left, here on the right, we need 1 ERC, okay, a pause, another ERC. So that's 3 candles. Make sense? 3 candles. So we need, remember, for a CP, okay, for a pause in the market, we need only 3 candlesticks. We need always an ERC candle, legging a ERC, basing structure, leg out ERC. We can also use the fail ERC candlesticks, okay, which look like an ERC. It's explained in the lessons, okay? So if we need 3 daily candles, okay, for a CP, the CP does not necessarily need to eliminate an opposing area of imbalance, okay? We are talking about price action itself, not about the accomplishments of those candlesticks, of these patterns. Make sense? Does it make sense? That we are not talking about the elimination or the removal of an opposing imbalance. We are talking about price action itself. It does not need to eliminate. We're talking about pauses in the market. Okay, they will be tradable or not, depending on the realignment rules and depending on its accomplishments. If it eliminated an opposing area of supply, in the case of this leg out, okay, bullish legs, okay, if we remove an area of supply here, then this will be tradable. But you need to put this into context. We need you to put this, if this is daily, you need to put this into context, comparing it with the weekly and the monthly time frames, because the daily is used, the daily time frame is used as the end time frame of the monthly, weekly, and daily sequence. Okay, so if we have 15 daily candles in a 3 bullish ERC impulse, then we can have 15 daily candles. And potentially we can have, okay, 5 CPs, because 5 multiplied by 3 equals to 15. which is what we had there, what we had here. Make sense? I'm trying to go slow so you can understand the idea behind all this. Good, perfect. So we can potentially have 5 CPs on the way up. What does that mean, 5 CPs on the way up? Potentially, okay? Overextension. We only need 3 for overextension. So if we have these, interchange zone, when we have the interchange zone, we have the candlestick like this and the candlestick like that as well. If we have small wicks like this, then on the lower time frame, if this is a weekly, we are going to have a daily CP. If this was the daily candlestick, then we would have 4-hour CPs. If the candlestick, if the interchange zone, okay, has very wide or long candlesticks, imagine this is daily, then on the 4-hour, okay, on the H4, that upper wick and the lower wick would create a valley. Make sense? That's how it works. You can check that yourself. It's always like that. Sometimes price acting a little bit tricky, and those valleys look like CPs and all that. You know the rules. Okay, so that would be a valley. So if we get a valley here, that's great, because if we get a valley here, what do you think? Let me ask you. What do you think has higher probability of playing out? A CP or a valley structure with a bullish engulfing pattern here and all that. So if we get a valley, it's even better. Why? Can anyone tell me the rationale behind it? Behind what I'm trying to put forward here when comparing the CPs and the valleys. Why? Yes, a drop rally, Francis, but why do valleys have higher probability than CPs or pauses in the market? It shows more strength, Jonas is saying, but that's something which is inherent to it. But why? Market dynamics. I'm talking about market dynamics. Francis is saying that the CP is a continuation pattern. Yes, it is. C is saying, wow, move. No, I mean, price action is said. We're talking about how the market works. So why does a valley has more, let's say, quote unquote, reliability than a pause? Brian is saying that sellers are removed. Ocean Diver is saying CP is a momentum play, but valley pullback is a stop and resumes. Exactly. That's what it is. Okay? That's what I believe it is. Okay? So a valley has already absorbed and overcome selling pressure. Say Jay Moores, correct. Exactly. So that's, let's say, so if price has been rallying, okay, and then pauses and rallies, pauses and rallies, that's good at the beginning of the move, okay, but as price keeps on rallying, then all the buyers are exhausted. I mean, the big players started to move, and then you see the breakout traders and all that trying to make some profit out of it, adding more positions to the move. And then when price is exhausted after 2 years, it usually retraces to the interchange zone. And if it doesn't retrace to the interchange zone, it probably has created 2 or 3 CPs, as you can see here on the 3 ESCs scenarios. And then when that happens, going long here after such a strong move, we can also consider this overextension on the weekly after 3 or more CPs. That's great. I mean, that's great because we now know where the buyers are, right? At the bottom. So on the way up, if price continues to rally, and then that's like that, okay? And there was a valley there, okay? The correction has already happened here. it tried to correct, and it's saying, no, I'm not going to retrace the origin of the move, okay? The buying pressure is so strong that then this lower wick here in the weekly, this is telling us, no, the correction has already happened, let's continue to rally. And that's why we want valleys. The correction has already happened, okay? And it is not just a pause in the market. The take profit happens on the lower time frames for those trading intraday probably and all that. They're happy with the results and all that, and then we have the trend resumed on the way up. So once the correction has happened, it forms a valley. So it's better to have the correction before planning to go in the direction or resuming buying in the direction of the previous trend, in this case a bullish impulse, a bullish trend. So that's why the CPs have lower reliability. They have high reliability, sorry for the word, it's a little bit complex, in or at the beginning of the move. But as price continues to rally for 2, 3 or more ERC candles, then the CPs lose all the edge that they had at the beginning of the move when a bigger time frame, probably the monthly, weekly and all that, have gained control. So at the beginning of the move, it's great to have CPs because obviously that's how the market works, and there's no time for price to retrace because all the accumulation is happening already very, very strongly. Lots of orders are placed in the market and there's no retracement. Okay, but if price continues to rally strongly on 2 ERCs or 3 ERCs, then it is not high probability. Make sense? John F is saying, brilliant, never heard it this way. Great. I mean, this has to make sense. It has to be logical to you, so your mind absorbs this knowledge and this structure, and you will be able to put it into context every single time that you look at any price chart. Okay? So explaining this in a lesson is a little bit difficult, okay, because there are many variations. So on the way up here, on these 3 ERC candle scenario, we have one CP. Probably if we've got these small wicks at the interchange zone, we're going to have at least 2 CPs, at least 2, okay? No overextension yet, but here we've got 5 days or 3, 4, 5 days, depending on the pause. Here as well. So we have a lot of probabilities to have CPs created within the structure of the weekly. In this, we are talking about the weekly. If it was daily, it would be the same. 5 4-hour candles or 6 4-hour candles, the same thing. Okay? 2 possible CPs. So since price is fractal, this explanation on the weekly interchange zones can be extrapolated to the daily bullish impulses, to the 4-hour bullish impulses, to the monthly bullish impulses, so on and so forth. Okay, so 2 ERC candles, we can go at the interchange zone. If the interchange zone is a valley, it's even better. Okay, 3 ERC candles, we have to wait for the origin of the move. Okay, because there will probably be overextension, or at least we want the correction, we want price to drop. It will most likely absorb 1 or 2 CPs, and then when it gets down there, probably a 50% retracement and all that, or even lower, then we are going to find that price sometimes that does not retrace to the origin of the move down there, origin of the move, okay, at the weekly imbalance or the imbalance. Time frame doesn't really matter. And then we get a bullish engulfing pattern. So that's when the engulfing lights lesson, okay, lesson comes in. After a very strong drop in price, we've got a bullish engulfing pattern. Hey, price is not dropping anymore usually. And moreover, if we have this, imagine this scenario with a trend line. So price, it has happened today on this day, okay, or these days in this day. So let's take a look at Disney, for example, okay? Let's take a look at Disney. It was not on my list, but I just remember it because I posted an update today. So let's do this. So I want to keep track of the stocks that are, the assets that are, oh my God. This is just not coming back. Crazy stuff. So let's take a look at the weekly time frame. Okay, this is an all-time high scenario, and this is very often in stocks. Okay, so we've got a weekly area of demand. Remember that this is all-time highs. All this is all-time high territory. All this from here to up there, everything is all-time high. Okay, so what do we have here? We have that there's another weekly area of demand created over there. Come on, I want to draw it. Getting used to the new software on the Mac. Okay, sorry for that. And what do we have here? Trend line connecting this valley with this valley. So we've got the first valley that we have. This is the first one, and this is the second one. We always start from the top for a bullish trend line. Okay, so this is the valley. There's nothing here on the left. So here is the valley. Make sense? So what do we have here? Super strong impulse made of 1, 2, 3, 4 ESC candles. We were talking on the dashboard that if we get 3 origin on the move, we had on this scenario, on this day, we had 4 ESC candles. What does that mean? 1, 2, 3, 4. Bearish engulfing pattern. So we've got 4, okay, and then bearish engulfing pattern. Okay, we want to wait for the origin, for a retracement, a correction to the origin of the move. Make sense? This makes sense? I'm trying to explain it very slowly and as clear as I can think of. Okay, probably I could explain it better, but I'm trying to do a good job here. Okay, so what do we have here? So, oops, this is the dashboard, the whiteboard, sorry. So I had my alert set right there, and it fell short of retracing to that imbalance. It's a pity because I wanted to go long there, and I wanted to go long there, but that's how trading works. So this area of demand, why is that an area of demand? Okay, because it broke all-time highs over there. Not only that, but it also broke the trend line. Okay, accomplishments, all-time highs, broken, all-time highs, sorry. So very basic structure, 1, 2, 3, 4, 5 candles, great. Structure, the strength of the impulse, 1, 2, 3, 4, 5, great. So no matter what, okay, the uptrend on the weekly, on the 3 months, on the monthly, everything is up. Okay, so we've got this weekly average demand responsible for eliminating all-time highs, consolidation away, a move that is probably 4 to 5 R, that is the distance from the proximal to the distal line. Okay, I mean, this is a set and forget trade. It's great to go long here, but what happened? It fell short of retracing to that area because we had the trend line confluence. So much bullish pressure, buying pressure, that it just couldn't retrace to the origin of the move. Then the Nasdaq and the S&P and all that started to rally again in a long-term, long bias, and no looking back. Okay, make sense? Thank you, Frederick. Okay, so this is what we were expecting. What happens here as well? That if we drill it down to the monthly time frame, and should be here, monthly time frame, what happens here? Again, the same thing. Let me clean this a little bit. We had that monthly average demand. We had another one at the bottom. Remember, this is all-time high scenario, all-time high territory. Okay, so bearish engulfing pattern, price, we want the price to drop on there. It didn't. This was an area of demand, but it didn't make 2 to 1. Okay, so it eliminated the area, but this one has got a super ERC candle. So longs down there, that was a weekly average demand nest down there, and it's falling short. So we can go long a new average demand on the daily if you are using the monthly sequence. Okay, make sense? All good so far? So if we go back to the weekly time frame, remember what we were saying here on the strength of the impulse, 3 or more ERC candles, that we could have several CPs, at least potentially 5. If there are 4 candles, potentially 18 pulses, okay, potentially. So let's take a look at this example, which happens to match the explanation that I was doing. I just remember about the Disney scenario because of price falling short on that, and it happens that we have that scenario itself there. I'm talking about this scenario for 3 ERC candles, okay? That's the weekly time frame. The time frame is irrelevant. This one could be, if I had hidden the weekly watermark here, then I would say this is the monthly. Okay, no problem. This is daily. Okay, 4 hours. It doesn't really matter. We are talking about market structure and context. The amount of time represented by every single candlestick is irrelevant, superfluous. Okay? Ocean Davis asking something. Alfonso, sometimes I'm confused of consolidation away rules. Does the candle OHLC needs to stay away from the imbalance or from the basing? From the imbalance, I mean the basing structure. Every single imbalance is made of a basing structure or a drop rally or rally drop. So consolidation away needs, once you draw the basing structure, consolidation away means that we need the candlestick staying away without touching the proximal line of that basing structure. Make sense? Ocean Diver? That's what we need. Okay? Okay, good. So 4 candles, so ERC candles. Now let's drill this down to 1 time frame lower. Okay? You see here, this upper wick and the lower wick. Don't you think that on 1 time frame lower we would have like a sort of valley? Think so? It's like a V shape already on the weekly. So that could be that area over there. I'm going to draw that one over there with an ellipse. Okay? And what about that one over there? Okay? Look at that. The bearish candle and then this small one. So that means that we also have a valley. Okay? That's also a valley. So let's take a look now at the lower time frame on the daily. On the way up, okay? So on the way up, as you can see, this is not a pause. Remember what we were saying? Oh, okay, let's put this into context so we can see the weekly time frame, well, at the top. Okay? So that one over there, I was referring to this structure on the weekly. Okay? So this is not, okay? This is not a a pause. This is a rally, then price drops, and then rallies again. This is a valley. So we were talking about the second interchange on the weekly, and then we said it was a valley, and here there you are, you've got a valley as well. So it would have been great to go long right there when price was there. It's looking to go long there, but price never pulled back. So price continued to rally and rally for 5 more days, 5 more days, 5 more days, 4 weekly bullish ERC candles. That is one rule that we should not break. Once we have a very strong rally made of 3 or 4 ERC candles, remember, we are expecting a retracement to the origin of the move. Will that retracement happen? No idea. But do we care about that? We shouldn't care about that. That's what we are expecting. That's our expectancy. That doesn't mean that it's going to happen. That's what we are waiting for. We were waiting for price to retrace down there. It didn't. Down there, it didn't. What can we do about it? Nothing about it. We just set our alerts and wait for price to drop and retrace to those areas. If it doesn't retrace, no problem. Next one, next one, next one. That's how it works. Okay? But remember that strong impulse, origin of the move. 2 ERC candles, interchange zone can be traded. 3 or more, no. So what happens now? What happens if prices here on the 2 ERC candle, this took 5 days to form? Okay, this is a weekly candlestick. Okay, and then the very next candle, Monday morning, price opens, price drops there. One single day, my friend, one single day. And this should have taken 5. We've got a problem, haven't we? Big problem, because we have the arrival into the interchange zone, okay, took one single day, one single block of time, let's say. Here, 5 blocks of time, 5 candlesticks. Not good. We want price to stay, gravitate away, consolidate away here, and then slowly approach. The slower it approaches to the interchange zone, the better. Okay? Or at the origin of the move, it doesn't really matter. Okay? If it takes 2-3 candles, it doesn't really matter. But if in 1 or 2 days price is down there, imagine 2 days and price is like that. What do you think about this, about going on there? What do you think, Brian, Ocean Diver, Frederick, John F., everyone? Would you be thinking of going on down there? No. Correct. No, it wouldn't be a good idea, because this took 10 days of time and it just took 1-2 days to do just that. Very dangerous. Okay, not good. Yes, the price velocity, what I'm saying, time value of the price action. In options, time value is also a time value, you know that. But we are talking about the time value, the inherent velocity or time that every single candlestick has. Okay? So, but only one time frame is not enough to make a trading decision. So that's why we have the realignment, and it has 3 time frames. The top time frame, okay, the middle time frame, and the lower time frame. So you can change, you can use the monthly here, or the 3 months, or the weekly, or the daily, and that will change the sequence and obviously the trend direction, because several sequences will always coexist at the same time. Always. So you have to decide your sequence and stick to it. And if you want to trade the monthly sequence and the weekly sequence, or the weekly sequence and the daily sequence, do that in separate accounts. Account 1, account 2. Otherwise, the good results of one sequence will probably be very affected by the bad results of a lower time frame sequence. We don't want that to happen. Brian is asking, is there a time frame formula we can use as a guide in terms of too fast of a return? No, no need. I mean, time frame is just, since price is fractal, the time frame is irrelevant. You just want price action bits. I mean, there's a bit of price action, another candlestick, another candlestick. So it doesn't really matter the time frame. We just want price action. 1, 2, 3 candles, and if the next candle, one single candle that's like that, okay, this is not good to go long on there. So that's the velocity of price action. The time value of price action. The underlying time frame here on the watermark is irrelevant to that. Okay. Brian is asking also, so 1 day to previous candle that took 5, not sure if that makes sense. To previous candle that took 5, that's what I'm saying. Yes, 1 day or 1 month, it doesn't really matter. Okay. And what I say, momentum. So if price rallies, and then look at this, look at the strength of the move. So if you compare Brian or anyone, okay, look at that. Bullish move made of 5 ERC candles. It took 5, let's say 5 units of price action to form the imbalance at 1, isn't it? You follow me? 5 units. It doesn't really matter. 5 candlesticks, 5 bars, anything, okay? So we have 5 units, okay? 1, 2, 3, 4, 5. So on the way down, once price prints the high, this is all-time high scenario, okay? All-time high, ATH. How long does price take to return to the origin of the move, or tries, okay? Trying to return 1, 2, 3, 4, 5, 6, 7, 8, 9. So 5 units versus on the bullish move versus 9 units, okay? 9 units on the bearish move. Which one wins? Ocean Dive says no, 9. No, that one is the one that loses. Why? Because we are talking about time value, time. So the more time it takes, the weaker the price action is. Okay, no problem. He's saying that laughing out loud was just kidding. 5 units is stronger. So Brian, right, I'm asking if it took 5 units, is that low enough? Is there a minimum? No, there's no minimum. We could have, like I said before here, 2 units, okay, and then it takes 1 unit and 2 units to retrace. That's like imbalance. But then you have to put that into context. And what is the context? That we have a bigger picture uptrend, 3 months uptrend, monthly uptrend, weekly uptrend, and the bullish impulses are stronger than the correction. Bullish impulse, correction, correction. Bullish impulse, correction. So as long as we have bullish impulse, the impulses are stronger than the corrections, it's fine. Okay? It's fine. It doesn't really matter. That's what I'm trying to say. Okay, he's saying, okay, units versus units. Sorry to keep asking, but got it. Don't worry. You can ask as many times as you want, Brian. We are here to help. I'm just trying to explain what I understand about market structure, impulses, correction, time value, velocity, altitude in the range, all that put together. So your mind puts all these pieces of the puzzle together and understands every single bit of price action when you are on your own looking at the charts. Okay? Okay, good. Jack Pal is asking, Alfonso, if the departure was 2 years and arrival was 2 years, would that still be valid? Yes. If in the context of a rally, of a bullish impulse and bullish trend in the bigger picture, Jack Pal, perfect. When we have consolidation, not good. Why? Because consolidation, it's consolidation. You need to wait for confirmation, and also the price action is telling you 2 years and then 2 years. That means balance in one time frame higher than the time frame that where you are seeing those 2 years on the bullish side and the bearish side. Sorry. Ocean Dive is saying correction is slowing down. The more candle of the correction, it will be better. The better, right, Alfonso? Yes, correct. If the correction is 100 units, is even better. Correct, as well. Frederick is asking, how do we consider longs at weekly demand when if price retrace only in confirmation? But in which scenario, Frederick? In this one, set and forget. No confirmation. Why? Because 3 months up, weekly up, monthly up, everything's up. So why confirmation? No need. Set and forget. Okay? John is asking the valley at June, which one? June should be around here or there. Okay, he's talking about that valley. Well, let's see what happens. It's 2 years candles, but we are going to put that into context. Remember, this is just one time frame at a time. So we need to see what we had on the monthly. If this is the anti-time frame, if the weekly time frame is the one that we are analyzing the imbalance, it has to follow the realignment rule. So if we are using the weekly time frame, then we need the monthly above it and the 3 months above it, because the realignment rules, realignment, RA needs those 2 time frames. So let's take a look at the monthly time frame to see what the monthly was saying. Okay. Syed is asking, how do we know if our AES is an emotional move or a strong move? You don't really know. After a very strong rally like this, very strong rally, 3 years rallies, if you see new ERC candles and all that, that's emotional. The big investors originate the move. They don't keep on buying and buying and buying and buying, because that's very expensive for them. Okay, imagine this is $100 and here it will be $300. So buying right now, it would be silly to hold a position for long term. Okay. Anwar, this also can be considered as a factor in scoring the zone as well. And what is mean the velocity of the correction. The velocity of the correction, the lower it goes, the better for set and forget. Okay, so let's put together in this one into context. Let's put this into context. Let's go to the monthly time frame. There it is. So what do we see here in the monthly time frame? This is all-time high, okay? All-time highs over there. So we've got an area of demand over there, okay? Consolidation away, but this is like 1-to-1 and 2-to-1 would have been there. So we had a weekly area of demand, but it was nested at a monthly area of demand that didn't accomplish the minimum 2-to-1 reward risk impulse. Make sense? So that weekly area of demand would have been negated. We don't need to follow with the 3 months analysis. Why? Because the monthly, the medium time frame has already negated the set and forget trade. Okay. What about this one? That one is quite better than this one, because we have like 3-4-to-1. So down there, yes. Up there, no. As simple as that. Can price retrace to that area over here, the nested weekly imbalance, and then rally from there? Okay, imagine this didn't happen. Okay, of course it can. Many times it will. But we are not talking about those scenarios. We are talking about the scenarios covered in the rules that have been tested for a long time. Okay, the higher probability scenarios. We don't care about the lower probability scenarios. So TB is asking, can we consider that candle from June an engulfing pattern? Here, yes, it is an engulfing pattern. That one over there, yes, it is. Okay, makes sense? Any questions about this scenario anymore? You're welcome, TB. Okay, good. Okay, good. That's Disney. Okay. Still a few more left to go over. But do you have any particular scenario you want to look at? Because I already did 4 on my side, so probably you have some. Then I could have a look at it. Okay. You're welcome, John. John F is saying, when an area is removed, look for a higher time frame zone. Exactly. So that's the power, and I believe it is a very, very powerful thing. It's the realignment rule. These rules that came up a long time ago, came up with. Okay, we've got 3 time frames. Any time frame. Okay, so the top time frame, middle time frame, and the lower time frame. Think of it as a GPS. We've got planet Earth here. This is the Earth. The Earth. So we've got satellite, another one. There are hundreds, thousands, And now with SpaceX and Elon Musk from Tesla launching so many satellites that we are not going to be able to distinguish the stars from satellites. I mean, I hate that. I mean, just progress is progress, but it's going to change because now Microsoft wants to do the same, Google wants to do the same, Amazon wants to do the same. So we're going to have thousands and thousands and thousands and thousands of satellites around the Earth. This is crazy stuff. I don't like that. But well, that's another thing to discuss. So we have the planet Earth and hundreds of satellites. So if we want to pinpoint the exact location of someone or something on planet Earth, we need, for fast or for accuracy, we need at least 3 satellites. The more, the better. Why? Because if this point moves here, then we have, like, let's think of these 3 satellites as ropes or chains that are connected, virtually connected, with an invisible thread to this point. So if you move here, move anywhere in the Earth, you're gonna be like tied to these 3 invisible threads all the time. But if you've got only 2, okay, then if you move down there, you could move on one of the axes. We've got the y-axis or the xy axis, and then we've got the z-axis, which is the depth of the move, the altitude. So with only the x and y, we would be missing things to pinpoint the exact location of any point on the triangulation, exact and where. So think of the realignment rules. I was going to end saying triangulation, but I'm were anticipated. So this is like the GPS. We want 3 satellites telling us where the imbalances are in context. So where on the Earth they are. So if everything is aligned, then we go long at the lower time frame. If the lower time frame is out of alignment, we have to be looking to trade at the middle time frame if it is aligned. We are supposed, or we're taking for granted, that we are dealing with a bullish trend. So the middle time frame, the lower time frame out of alignment, we go along at the middle time frame. The middle time frame out of alignment, we go along at the top time frame. So this is, you can change the top time frame for the 3 months, the monthly, the weekly sequence, the daily sequence, any sequence you want. Okay, even scalping sequence. It doesn't really matter. But you need at least 3. Make sense? Cartesian coordinates, Anwar, certainly. Systematic rules. The thing is that many times, as you already know, price will not retrace at the level and keep on rallying without us. But that's the way it is, my friends. That's the way it is. Trading supply and demand is patiently waiting for the imbalances. If you want to trade something else, then you should be looking at another strategy, learning another one. This is trading supply and demand. The imbalances are revealed to you. The fingerprints or the footprints of the big investors are revealed to you. You score them, you put them into context with 2 more time frames, and you decide. That's it. Okay? Okay, so Ocean Diver, Alfonso, sometimes on the analysis you create a bias. For example, gold, you create a short-term magic candle to the bottom. How can we trade it? Or is it just a bias? If you want to trade that, it means that it is counter trend, and you should be aware of the risk of counter trend trading. Or also, it means that you can use lower time frame sequences to trade on the way down. So let's think about this, okay? Every single trade or every single imbalance that you see on the chart is a counter trend trade. Every single one, without an exception. Why am I saying that? Anyone? Every single trade is counter trend. How can I make such a blatant statement? Every single trade is counter trend. Why? On any time frame. Yeah, Brian. John F. is saying you buying pullbacks. No. Why is every trade a counter trend trade? that's a little bit silly to say, no? Why? Because we are trend. I'm always saying we are allowed to go along only with a trend, but I'm saying every single imbalance is a counter trend trade. So you are it's a contradiction by itself. John F. is saying something that making sense. He's saying some other time frame is out of alignment. Correct. That's some of it is true. Ocean Diver, tricky to answer. I don't know the answer. Well, let me tell you. Let me try to explain what I'm saying. I'm always saying it in the analysis. On the weekly analysis, I'm always doing the monthly sequence analysis and the weekly sequence analysis. So the month is up. Where are you allowed to go? You are allowed to go long on monthly, weekly, and daily time frames, aren't we? Everything is up, we go long. So that's a trend trade, okay? But now, what about this? What if we add the 3-month sequence and the 3 months is down? Will the daily be a trend trade? No, it won't. It will be counter trend. Why? Because the 3 months is down. So if you go long, it's counter trend. So what I'm trying to say is the most important thing when you are doing the realignment, using the realignment rules to plan a trade, is the sequence that you decide to trade, and you have to stick to it. So the trend direction of the anti-time frame will depend on the sequence, on the top time frame of the sequence. If it is the monthly will dictate the bias. If it is the 3 months, the 3 months direction will dictate the bias. So on a monthly sequence, the daily will be a trend trade, but on the 3-month sequence, there will be a counter trend. So if you use the 6-month sequence, then obviously the monthly time frame will also, the monthly entry on monthly imbalances will be counter trend if the 6 months is down. So it all depends on this sequence. So the more time frames you add, the worse. Why? Because you will have bullish sequence, bearish sequence, bearish, bullish, bullish, bearish. So which one do you use? The bullish, the bearish, the bearish, the bullish, the bullish, the bearish? It's illogical, okay? So you choose only 3 and you base your trade decisions on the top time frame of that sequence. So many sequences can coexist and at the same time. So by the fact of having those many sequences coexisting, that tells us that choosing the sequence will dictate the trend direction of our time frame, anti-time frame. So if we are using the monthly sequence, this will be a trend trade because the month is up. But if we add one more time frame, it is counter trend. So the top time frame of the sequence will dictate the direction and the validity, the tradability of the imbalance. So depending on the time frame that you're using as a top time frame, the anti-time frame will be counter trend or not. So if we start adding more time frames to the top, then any single trade imbalance that we have on the lower time frames will be counter trend. That's why I'm always saying that you have to choose your sequence, stick to it, and forget about everything else. If you want to trade another imbalance, counter trend or whatever, then use a bigger time frame sequence. So you could say that the counter trend lesson could be eliminated, or the concept of counter trend could be eliminated if we use the sequence concept. Why? Because by using the sequence concept, we are not stuck to the ideas of trending market or counter trend market. We are sticking to the idea of a triangulation system using 3 time frames where the top time frame will dictate the bias. We are talking about bias and a sequence. Counter trend is irrelevant because it will depend on the sequence of time frames that you are using. If you are using the monthly time sequence, then you go long because the month is up. That's it. Counter trend, it doesn't exist because I am looking to trade on the monthly sequence. You want to go short in the monthly sequence, okay, maybe the daily is down. If the daily is down, then you can use the daily sequence to trade the 1 hour imbalances. Supply zones on the way down. That's trend trading on the daily sequence. Not counter trend. It's trend trading on a lower time frame sequence. Okay? Makes sense? I don't know if I got a little bit. One sec. I'm reading. It's difficult to explain. What I'm saying is that no multiple sequences can coexist, and you don't really need counter trend. Yes, different sequences to trade. Okay. John is asking, Alfonso, please. I have a quick question on Aussie versus Swiss franc. So please ask. Okay, so we can take a look at it. Okay, so in the meantime, we are going to, one sec, use or go to the Nikkei. Okay, let's go to the Nikkei. Somebody asked about it in the community. So on the Nikkei, we've got weekly, come on. We've got the, sorry, that's the weekly. On the monthly, we've got the monthly area of supply in control, fully penetrated. Okay, we've got a monthly area of demand here. Why demand? Because this area of supply was eliminated. Okay, then on the weekly here, we have weekly area of supply created in control, and here potentially we have a weekly area. Well, I think we have it already. Well, no, this is almost there. Another weekly area of supply. So this is enough. Okay, so we have price too high in the monthly range. We have price too high in the weekly range. So going long at areas of demand is a little bit too aggressive. Longs have been playing out here on the way up before, as you can see, it was located there before price reached the weekly area of supply. Once price reached the weekly area of supply, which is here, daily areas of demand, if this was demand, I think it was, and we would need to do the chain analysis, but no time for that right now. So this would have been too high. Why? Because this area here was right there, okay, and was right there. Okay, not a good idea. Go along. So what we were saying right now, or in the community, is that here we've got a weekly area of supply. This is a weekly area of demand over there. So we've got, this is just a bullish impulse, okay? It didn't, why only a bullish impulse? Because this rally here didn't eliminate anything here. Supply is there. So we can use this as confluence. Price rally over there, okay, and it's now again, I mentioned this in the community, again this bullish impulse, every single time price has reached that bullish impulse, okay, that piece of price action there was there, it rallied, there, it rallied, here, it rallied, okay? So going short there on the lower time frames is not a good idea. Make sense? Does this make sense? Okay, every single time price has retraced that price area, which is not demand, okay, because there was no accomplishment, then we can use this as confluence, okay, and then go along a new areas of demand. So if we do the chain analysis here on the daily, we're going to see something interesting here. Why? Because we have, this is a peak, another peak. What do we have here? We have an area of demand, okay, eliminated already. We also have another area here of demand on the left, here at the origin, over there, still in control. So if you want to trade 4 hour areas of supply here, look what we are. we have this daily average demand. This belongs to the daily average demand, okay? And this here is 4-hour average demand as well, okay? This is being eliminated there. Then this was supply, eliminated, loss, demand, eliminated, loss, okay? Not strong enough. Price action here is a mess, okay? So wanting to trade here is not allowed. This is not a strong area of supply. It is supply, okay? Why? Because it eliminated this area of demand. We have the chain analysis here done, okay? So this 4-hour area of supply is too low with the daily area of demand in control, 4-hour area of demand in control, and the bullish impulse on the weekly. So we have all that, great, no shorts. Here it would have been great. Why? Because here, when price, if price had retraced over there, because the daily average demand wasn't in control yet. But now that it is, not possible. And remember, this is a bigger picture uptrend. All the, or most of the major indexes, Nifty, Bank Nifty, Nasdaq, S&P, Dow Jones, many world indexes have broken all-time highs and all that. So we are expecting that to happen on this one as well. When will that happen? Well, we don't know, but that's what we are expecting. Why? Because the 3 months is in an uptrend. Okay, we've got the bearish engulfing pattern confluence for short on the weekly and all that, but if it breaks higher, okay, it's still in an uptrend. Okay, right now it's just an obstacle. So we are expecting that to be eliminated as it happened on most of the world indexes. That's what I wanted to cover on this one. And now let's go back to the to John's question on Aussie versus that one, Swiss franc. So let's see. Let's look at his question. Okay. So he's asking, on the weekly sequence, were we allowed to go short on the last 4-hour valley? Or I guess you mean peak, because if it is short, it's a valley. It's a peak here. You mean here? I guess you mean that one. Okay, so let's do the top-down analysis. Okay, so we've got the weekly, the monthly is in a downtrend. Okay, no price action here. All-time lows, maybe on this one or maybe on another one. On ICE, we've got more price action, yes, but look what we have on ICE. Okay, let's go back to that one. On Oanda. This is Oanda. Okay, good. So we have 4-hour area of supply. So all-time lows here. That should be supply on the daily. Okay. On the weekly, we have this trend line broken, demand eliminated, the wow eliminated. So we are creating supply. It's not yet confirmed. Why not confirmed yet? Because in order to have supply here, we need to eliminate and consolidate away. So 2 days, and it has already printed half of the distance printed by the bearish candle. So maybe tomorrow price is there. So 3 days versus 5, no set and forget. Make sense for now? John? On the weekly, that's what price action is saying. Okay? So we have to be careful here. So now let's do the analysis. So the weekly is down because we have demand eliminated. Okay, so we have one peak here, another peak there. So weekly is in a downtrend, month is in a downtrend, everything's in a downtrend. Okay, so we've got a strong bearish impulse. We've got a daily downtrend, 2 ERCs, good for shorts, and then we have the interchange zone here. That should be a peak, as explained in the whiteboard before, when we have one lock long lower wick and short upper wick, that means there is a peak over there. So within that area over there, a price action, there should be an area of supply there, which is that one over there on the 4 hour. But then would have been valid, anyone, to go short there? Anyone? This is a valid area of supply in the 4 hour. Everything's down, so we go short. Don't we? Everyone agrees it would have been a loss? Or not? So Ocean Diver is saying non-valid because weekly didn't consolidate away. That's incorrect because it is trying to consolidate away, but for consolidation away, we are talking about the validity of the imbalance right within the impulse, the basing structure, not here. Okay, not here. So that's incorrect. The trade is there. I mean, look at that. Look where it is. One sec. There it is. You can see the cross here across the board. Okay, that's where it is, at the interchange zone over there. So was that valid? Ocean Diver, but doesn't it say weekly doesn't consolidate away, all time frame entries negated? Yes, but you are not understanding the rules within the basing structure. The consolidation away, we are talking about this bearish impulse. It has to consolidate away in order to take shorts within the basing structure of the potential supply. This has to consolidate away. It doesn't talk about this. We are talking about this. Those are the rules. They have always been like that. Jack Pal said the right answer. It was not allowed to go short, and there is, but he said the answer. I'm just waiting for somebody else to say the same thing. Remember, Ocean Diver, consolidation away. We've got basing structure, impulse. So we are allowed to trade there if price consolidates away. On the way down, there will be lower time frame areas of supply that are tradable as per the realignment rule. But once price reaches that impulse, that basing structure, if there is no consolidation away, then no trade within the area. Okay. So Ocean Diver said, also replied correctly, 4 hour is out of alignment. Okay, so John asked if it was a valid trade. No, it wasn't. Why not? Because we have 3 time frames. Everything is down. Okay, good. That's great. So that price action is saying, or the 3 alignment rules saying, we have short bias on the monthly, short bias on the weekly, short bias on the daily. Everything is down. Great. We should go short of 4 hour areas of supply. But what do we have to do as well? We have to draw the trend lines. This is a peak. Okay, this is a rally drop. So that's the first peak and the second peak. So we do this. Trend line is broken. Okay, so no shorts. No shorts are allowed. Like that. Correct. So trend line broken, no shorts allowed. Yeah, it was like that. I mean, look at that, connected without cutting through candles. Okay, this candlestick on the 4 hour is not touching the trend line. So 4 hour out of alignment. Okay, good night, Junior. He's leaving. So that's it. You have to draw the trend line correctly. Otherwise, that's what happens. If you were short on that price dropped, and then you see that it's running again strongly, it's time to manage your stop loss. Okay. Ocean Diver. So non-consolidation away on the weekly, I think daily supplies within the weekly non-consolidation away supply. Non-valid, that's for sure. Correct. unless weekly consolidates away. We need 3 more days for that to happen on the Aussie versus the Swiss franc. Come on, we need 3 more days. Okay, see, he is asking me to discuss pound CAD. Okay, let's go to pound CAD. That will be the last one. There it is, very similar to others. Okay, pound CAD. There it is. So, this is what we have on pound CAD. Brian, real quick, on last one, was the 4 hour not nested in daily? No, it wasn't. 4 hour nested on daily. This one over here is not nested on the daily supply. Supply is, let me sync to all charts, look where supply is on the daily. This is not nested within. It's very far away. Okay? Okay, pound CAD. Again. Okay, good. So here on this one, we have the trend line break. Okay, so we have supply over there. Come on. Getting used to all the shortcuts, the command key and the option key on Mac. I'm used to Windows and all that, and it's just all that. So monthly supply is in control. Too aggressive. That's the first thing. Too aggressive to go long. Okay, why? Because monthly supply is in control. Then let's take a look at the weekly. We have the weekly area at the top here, eliminated. I think it was eliminated. I don't have right now. Let me do this. Nope, I don't have that one over there. But I believe it was eliminated, barely eliminated or not. High here is 77,962. 77,941. No, it is not eliminated then. Okay, it is in control at the top right there. Then we've got here trend lines and all that. So we've got weekly area of demand in control. That eliminated that weekly area of supply and all that. The trend line is probably broken, supply, new supply created. But we have monthly supply in control, weekly supply in control. So going long at the daily is very aggressive. We have here trend line broken. Come on. Weekly supply, daily supply almost in control. I like that as well. Very high in the daily range. So we have very high in the daily range, very high in the weekly range, very high in the monthly range. So going long is not a good idea now that we are very high. It would have been great to go long down there, a price never retrace, but down there is not a good idea. So we have this price action, 2 ERC candles, then very high on the daily range, weekly supply against control. So going long at this interchange zone right there is not a good idea. So is this demand? I don't know. Let me see, because we need to do the the chain analysis. It has to remove something on the left. Okay. So this was certainly demand. Trend line break, supply over there, probably supply here on the left, eliminated by what? This. So this one was eliminated. The close, this is not supply, okay? On the 4 hour. Why? Because this price dropped and accomplished nothing. So this is not supply. If this is not supply, then this is not demand. Makes sense? Makes sense. This is just a bullish impulse that accomplished nothing because the accomplishment was there and this was the demand area, not this one. Makes sense? That's how it looks like. So 4 hour area demand was invalid there for that reason. Too high in the weekly range, too high on the daily range, too high on the monthly range. So going long is not a good idea, even less on the 4-hour, because we have 3 time frames above or bigger than the 4-hour, 2 of them in control, another one almost in control. Too high in the range of 3 time frames bigger than the 4-hour, and this bullish impulse was not even demand. Okay, makes sense? Yeah? And you were asking Aussie Cat as well. The Ocean Diver. But let me see if it was valid. Another one. Can we go short on the 4-hour average supply after the daily trend line is broken? If the daily trend line is broken, yes. Otherwise, no. But still, the daily is uptrending. So going long right now, going short, not good. Trend line confluence. Not good. Tricky scenario. This one, I would leave it alone for some time until we have some clear direction on the bigger time frames. Make sense, all this? Okay, good. So I believe that's everything for today. We have covered the arrival to the level. We have talked about the speed or the velocity, the units, the strength of the impulse. We have talked also about the interchange zones, the number of candles within the ESC candles, the potential of an ESC candle to contain or be made of several CPs and create overextension, that after 2 ESCs, long interchange zone are good to go. Obviously, if there is no bigger time frame area of supply and control, like now, right now on the pound CAD, no good. Okay, we are talking about scenarios where there is no obstacle, okay? So if we get 3 or more ESCs, then longs at the origin of the move. Then there will be times when there are bullish confluences like a trend line and all that, and then their price might stop and prevent price from dropping further like it did on this day, preventing price from retracing to the weekly area and monthly areas of demand explained during the webinar. Okay? Brian, awesome. Best one yet for me. Thank you so much. Thank you, Brian. Have a good night. TB, on the left and weekly area are those pauses. We're already done, TB. So whatever you want to ask, do it in the community. Okay? Thank you, everyone. And thank you, Ocean Diver, for your kind words. Ask those questions in the community, okay? Because we are already done with this webinar today, okay? Thanks a lot. Have a great night and talk to you very soon, my friends. Bye-bye.